Well, St. Louis Fed President James Bullard is weighing in on the recent banking chaos and what it all means for the economy. This comes as the threat of a recession has reared its head again after some data this week showed signs of a weaker economy. Yahoo Finance's Jennifer Schonberger is here with the details. Jennifer, what are you tracking?
Good morning, Rochelle. St. Louis Fed President James Bullard says he doesn't think the reverberations from the recent bank failures are enough to tip the economy into recession. On a call with reporters just moments ago, Bullard estimated that 20% of bank deposits were leaving the system in search of higher yield, and that right now it's not clear to him that there will be much of a pullback on lending and thus a tightening in credit conditions. He said as long as banks have enough liquidity and capital, it seems they would make those loans if they were good ones to make. Now, on this point, there's been talk about lowering the interest rate on the Fed's reverse repo facility to encourage money market funds that have been parking cash at the Fed for higher yield to instead lend that back out to banks to get more money into the system. But Bullard says no plans to change that right now. Now, I also asked him about the latest JOLTS report that showed the biggest decline in jobs openings in nearly 2 years, though Bullard telling me he's not really drawing much conclusion from that data as it relates to a balancing out of supply and demand in the labor market. He says that right now, if you want a job and you lose one or you leave one, it's pretty easy to find another one in this environment. Rochelle?
And Jennifer, obviously a lot of people are going to be looking at every word that comes out anywhere from the Fed, especially since we are quite a ways away, it seems like, from their May meeting. Do you think this helps really perhaps at least get some of that messaging out there about the impact of the Fed really trying to balance this game of financial stability with trying to bring down inflation and stay the course?
Yeah, I think when it comes to Bullard, he seems to be a bit more focused on the inflation front. He puts the odds of about 85% that we are not going to see continued massive reverberations in terms of financial stability, and thus we will end up with sort of a slower growth scenario where the Fed is still going to need to focus on bringing inflation down. He is very aware of what happened in the 1970s. He does not want to repeat that, where essentially the Fed stopped raising rates, then had to come back in and really aggressively jack up rates. And that's really something that the Fed wants to avoid, because that's when you really get into scenarios for a severe recession.
Indeed. Jennifer Schonberger, thank you so much for that update.